Good morning, everyone. I'm Kumar Venkataraman. I'm at Southern Methodist University. And this is joint work with Amber Anand, who's at Syracuse University, and Pab Jyoti Kasira, who's here, my colleague at SMU. So this is going to be quite a different paper from the first few that we have heard this morning. The first few had very sort of broad macroeconomic policy implications. On the other hand, this paper is in the field of microstructure, so this is going to dig into transaction level data with, again, some public policy implications. But of course, it's going to have a very different flavor. So first of all, I want to thank the conference organizers for this kind invitation. I actually grew up in Mumbai, and I've been an academic for over 17 years, but I've never presented at a conference in Mumbai. So I really want to thank them for inviting me, because this is very special, and I've really enjoyed it. So thanks a lot. Okay, so this is about the bond market and about trading in the bond market and about issues related to liquidity in the bond market. So I think many of us are more familiar with the stock market. In the stock market, there's a lot of data. We have algorithmic trading, high-frequency trading. We've had a lot of discussions surrounding that. On the other hand, the bond markets tend to be a bit opaque, a bit under the radar screen. But in fact, bond markets are larger than equity markets. And so in the bond market, a bond market is a little bit like the car purchase market. So if you want to buy a new car, what you typically do is you call up one dealer who's selling a car. Say you want to buy an Audi A4, you call a dealer, and the dealer gives you a quote, and then you call the next dealer, and the dealer gives you a quote, and then you call the third dealer, he gives you a quote, and then you figure out which quotation is most lucrative or attractive, and then you follow up with the leader, with the best dealer, negotiate, and then finally agree on a price. So trading in the fixed income market generally follows this pattern. So we have the sell side, which are the dealers who are supplying liquidity, and then on the buy side you have customers. These could be institutional customers like mutual funds, pension funds, insurance companies who are big players, but also retail investors who are, again, participating on trades with the dealer community. Now, there has been a growth in electronic markets in the US, but these electronic markets also do not really change the structure of how liquidity is provided, because all these electronic markets do is, instead of picking up the phone and calling a dealer, these electronic markets allow you to use an electronic communication network to send a request for quotation from a dealer. So for all practical purposes, the market structure did not change. What just changed is the way in which your request for a quotation to buy an Audi A4, instead of using the phone, now you're using an electronic messaging system. So the key is that dealers play a very important role in the fixed income market, and these markets include treasury securities, corporate bonds, municipal bonds, structured credit products, etc. And all of these instruments are trading in this dealer market, where customers trade with dealers, and then dealers in turn manage their inventory risk by trading with other dealers in the inter-dealer market. So that's the structure of this market. And so what motivates this paper are a few interesting trends. First of all, there's been an explosion in the growth of corporate bond issuance in the US. Here are some statistics. The market was $4.8 trillion in 2006. It's $8.5 trillion in 2016. In 2016, equity issuance in the US was $200 billion. Corporate bond issuance was $1.5 trillion. So what you're seeing is that the size of the bond market is just expanding. It's just becoming, the pie is just becoming larger. But at the same time, the key intermediaries in this market, who are the dealers, have reduced their capital for market making. And this kind of ties with some of the discussions earlier on today about regulation. Because what has happened is that the big dealers in the fixed income market tend to be the big banks. So JP Morgan, for example, is a very prominent dealer in the bond market. And after the financial crisis, bank regulators were worried about the activities of the banks, and so they started constraining what banks can do. And so they had the Volcker rule, and so they had capital requirements, and so they forced the dealers to reduce their proprietary trading activity. And they allowed dealers to participate in market making. There was specifically exemptions written in the regulation saying, hey, you the dealers, you can participate in market making, but you should not do proprietary trading. But the problem is that bonds do not trade very often. And because they do not trade very often, the inventory tends to be very slow moving. It's very different from equity markets, where inventory of
a dealer in the equity market or a market maker crosses zero all the time. Sometimes it's positive, crosses zero, goes negative, goes positive, and this happens several times within the day. In the case of the bond market, bonds don't trade very often. So if you buy a bond, you hold it for a week or 2 weeks or 3 weeks in the case of high yield, riskier bonds. And so from the regulator's perspective, they really can't tell whether a position taken on by JP Morgan is market making or whether it is proprietary trading. And because these banks have to report to the regulators, banks are saying, hey, the regulators cannot figure out whether it's market making or prop trading. I'm actually doing market making, but I cannot credibly signal that I'm not doing prop trading. And so I'm just going to cut down the extent of my participation in this market. So you can see a number of papers that I've listed here. The first paper is the one that I co-authored with a few of my colleagues at SMU and also Hank Bisseminder at Arizona State University. This paper is forthcoming in the Journal of Finance. And in this paper, what we find is that dealers have reduced market making, and all this reduction in capital of dealers is mainly coming from bank-affiliated dealers. Non-bank affiliated dealers have actually stepped up, but they tend to be small participants relative to the big banks, and therefore overall market making has declined. So on the one hand, the size of the bond market has increased. On the other hand, the key intermediaries in this market have reduced their market making. And then finally, there's research showing that investors in these bond mutual funds, for example, are very sensitive to performance. So when the performance of the bond mutual fund is negative, investors exit in a very, very significant way. So this has gotten regulators worried because they're saying, what's going to happen in terms of liquidity if there is a shock in the market? Who's going to supply liquidity? Okay? And so here's a quote from the Securities and Exchange Commission. It's issued guidelines for bond mutual fund managers. And it's saying, look, you bond mutual fund managers, you're providing the ability for your retail investors to get liquidity on a daily basis on the liability side of the balance sheet. But on the asset side of the balance sheet, you're holding illiquid assets. So will you be able to actually fulfill your promise? So you need to take a careful look at what you're holding and whether you can actually convert it to cash to meet redemption requests. So you have to assess the source of your liquidity. Where are you going to get the money if you really need it? And so a recent survey by the consulting firm Greenwich Associates says that 78% of the credit investors, the big players in the market, say that the new liquidity providers are going to be buy-side institutions like BlackRock, the pension funds, the insurance companies, mutual funds. That's sort of the expectation in the market. However, there is very little sort of analysis, data-driven sort of work to see whether buy-side institutions like pension funds, insurance companies, mutual funds actually are sensitive to demand-supply imbalances in the market and whether they play the role of liquidity suppliers. So in this study, we provide some preliminary evidence on how perhaps one can address this question. Okay? So what is this study about? So we have, I have only 15 minutes. And so I'm going to take Susan's recommendation to heart, and I'm going to spend a lot of time on this slide and the next slide and basically describe the paper. And then, of course, some of you may feel that perhaps there are no results in the paper, so I'll quickly show you a few of the tables where we have the related analysis on this paper. Okay, so what we are looking at in this study is bond mutual funds. So these are retail investors who are investing in mutual funds. And these mutual funds invest in the bond market, so they invest in bonds. And we are looking at whether these mutual funds play the role of suppliers of liquidity. And these mutual funds are important. The share of their ownership of the underlying bonds has doubled from about 7% in 2006 to about 18% in 2016. So they are increasing in importance. And one of the contributions of the study is to look at a particular mutual fund and classify its participation based on its trading style. Okay? So how do we do that? So what we are looking at is transaction level data in the corporate bond market. So this is from a system called TRACE that was put together by FINRA, the regulator for bond dealers in the US. And beginning July of 2002, the regulator required every corporate bond dealer to report every transaction that it participated in, whether with a customer or with another dealer, to an electronic system. And so we have a more detailed data set provided by FINRA, which gives us not just transaction information. So every trade, the CUSIP of the bond that that was associated with the trade, whether it was a customer buy or a customer sell. But in addition to that, we also have information on the dealer who participated in that particular bond. So because we have information on the dealer who participated in the bond, we can build the inventory of the dealer. And once we build the inventory of one dealer in a bond, we can build the inventory of all the dealers in the bond by just aggregating it across all the dealers. And so what we identify in this paper is what we call an inventory cycle. An inventory cycle is when there is an excess selling pressure from the customer or excess buying pressure from the customer, which results in the inventory becoming different from 0 in a significant way. Okay? So here's an example of what this inventory cycle might look like. So in this scenario, we are describing a positive inventory cycle. A positive inventory cycle is when customers are selling a particular bond more than average, and the dealers are buying. And so when the dealers are buying, you have the load phase here, where that inventory goes up, it hits a peak, and then you have the unload phase when the dealers are getting rid of their inventory. So this is a scenario where the dealer community is facing selling pressure from outside, and they are sort of managing their inventory. So as you can see here, what we see in the data too is that as customers are selling, dealers are buying, but at a lower and lower and lower price. And so the bond returns tend to be negative during this load phase. And then as they're getting rid of the inventory, the bond returns sort of reverse. So the typical reversal that you see when there's selling pressure is what we see in the data as well. Now, once we have identified inventory cycle for a bond, so we do the same thing for all the bonds. So we have this in the time series, we have data from 2002 to 2014, where we have all these inventory cycles that we have identified. Then we move to the bond mutual fund data. And bond mutual funds are required to report their holdings every few periods. So 70% of the mutual funds in the US data that we examine report monthly holdings. So every month we can look at their holdings and we can see whether the holdings change was a positive or a negative number. So once we have the holdings change, what we can do is we can then overlay the holdings data on the inventory cycle. So let's take SBI, a corporate bond mutual fund. It has a lot of holdings, a lot of bonds. So if you follow it from one snapshot to the other, if the bond fund did not have any transactions during the period, there's no change in that particular bond in terms of holdings. So we ignore that. Suppose there is a change in the bond holdings, there's an increase or a decrease, but that does not overlap with an inventory cycle, then we ignore that because that change in holdings does not overlap with buying or selling pressure of the underlying dealer community. So what we look at are really changes in bond holdings at the same time when that particular bond has resulted in the dealers feeling buying or selling pressure. And then we correlate the sign of the inventory cycle. For example, if it's a positive inventory cycle, we ask whether this particular mutual fund in this particular bond has absorbed the dealer's inventory or whether it's contributing to the imbalance by selling during that period. So in the case of a positive inventory cycle, if a bond mutual fund has purchased the bond, then we say that in that particular CUSIP, the bond mutual fund is a liquidity supplier. Otherwise, it's a liquidity demander if it has been selling the bond. So once we classify for a bond that the SBI mutual fund holds, we do it for all the holdings, and then we have an algorithm where we aggregate it. So we can say that based on the data, SBI corporate bond mutual fund in February of 2014, its trading style was either positive, which would be liquidity supplying, or it's negative, which would be liquidity demanding. So we come up with a score, which is a liquidity supply score. And once we have done that, then we move on to look at a number of things. So the first thing we do is ask whether this trading style has some information or whether it's just some noise. Because obviously, if you run some sort of analysis on something, you're going to find some number, right? So what we show first is that this trading style is persistent. So if a particular SBI mutual fund, large corporate bond mutual fund, has a liquidity supplying trading style over this 12-month period, you go and look at the same fund in the next 12-month period, then there is information. So it continues to act as a liquidity supply. So there's persistence in the trading style, implying that they are consistently trading in a certain way. And once we have done that, what we also find is that there's considerable variation across these bond mutual funds. There are some funds who are very, very liquidity demanding, and there are other mutual funds who are very, very liquidity supplying. And once we establish that, then we go on and look at a couple of questions. First, we want to know who are these bond funds who tend to supply liquidity versus demand liquidity. So we're trying to model the cross-section of trading style. And what we find is that flexibility in the asset side of the balance sheet allows a mutual fund to actually act as a liquidity supplier. So for example, liquidity supplying bond funds tend to hold more liquid bonds, larger bonds, more actively traded bonds, younger bonds, etc. The liability side, the quality of the investor base also impacts their ability to act as a liquidity supplier. So for example, the investors in a liquidity supplying fund tends to be less skittish. The volatility of investor flow tends to be lower, implying that they tend to sort of hang out with this fund and not run away from the fund in terms of the way in which they participate. So those are some of the results, and we have some other results in terms of what explains the cross-section of the trading style. And then finally, we run an asset pricing model where we calculate the alpha of the bond mutual fund, and we show that trading style is associated with fund performance in a risk-adjusted manner. So what that means is a fund that has a liquidity supplying trading style adds alpha, whereas a fund that has a liquidity demanding trading style subtracts alpha in terms of bond mutual fund performance. And this is economically significant. And the difference that is imposed by trading style is much higher during periods when you have a crisis. So for example, there's a lot of alpha that one can earn if you supply liquidity during the 2007 to 2009 financial crisis, which is not surprising, but still, the fact that we see it in the data is more comforting because it seems that we are actually identifying trading style, impact of trading style. So the contributions of the study, we have this methodology which we feel will be quite useful to the literature on classifying trading style. We present some evidence that buy-side institutions, indeed, some of them have a trading style that is liquidity supplying, which is very important because right now regulators are very concerned about who's going to supply liquidity if the dealers are withdrawing from the market. And then finally, we contribute sort of to the asset pricing literature by showing that trading style is a fund attribute that is useful for forecasting performance. Thank you very much.
Thank you, Kumar. Anjali Sharma, Finance Research Group, IGIDR, will be the discussant.
So first I want to say thanks for this very interesting paper and very interesting presentation. So what I want to do is just for the sake of, since you just presented the paper, but I'll just summarize it as per my understanding. So what does the paper do? And in my view, it's an important paper. The question of liquidity in OTC markets is complicated, especially bond markets where there's wide variation in instruments, right? And hence, how does one explore the idea of liquidity in an OTC market setup is, so this paper provides some really interesting insights into that. So the first thing this paper does is, it says there are bond funds, and bond funds have some types of trading styles, which is, one trading style is that they take a contrarian view to what the dealer view is, which is when dealers are buying, these funds sell, and when dealers are selling, these funds, and this is viewed as liquidity supply. The second, so what the paper finds is that on an average, bond funds indeed are not liquidity supplying, right? And that's the key finding of the paper. The second thing this paper does is it says for funds that supply liquidity. So it then goes on to segregate the sample into funds that do not supply liquidity versus the funds that are liquidity supplying. It says, so there are these set of funds which supply liquidity, and it studies two things. The first is it studies the characteristics of the fund itself. And there it finds, as Kumar just pointed out, is that if the fund has a stable pool of investor funds, then its ability to take contrarian views to the dealer community is higher, which seems intuitive in the context of the market. The second thing it says is what kind of bonds do these liquidity supplying funds invest in? And here what they find is that they invest in bonds which are of shorter duration. They invest in bonds, new bonds. So I presume it means that in the early phases of the bond cycle itself, right? The other things it finds is that they are the more liquid bonds themselves. And then finally, the question that the paper addresses is, in adopting this trading style, is there some future benefit that these funds are attaining? And it finds, in fact, that there are alphas and there are positive alphas. And the positive alphas are higher when there is stress. So for example, they say that if there is one standard deviation from the TED spread, then what kind of alphas we find, and they find in fact that the alphas double. And that's an interesting finding in itself. Now, moving on to my comments in this space, right? So on the motivation, I'm not entirely convinced by the motivation of this paper, where so we seem to be saying a bunch of conflicting things. One, we say that increasingly the dealer community is focusing on the agency business in mutual funds. Right? Now, the agency business in mutual funds, and this is worth examining empirically, right? The question of building the inventory cycle, etc. So there's the first motivation it says is there appears that there are concerns about liquidity problems in the dealer market. And then nowhere in the paper do we find whether these concerns are real or not, right? So the question of whether there's a liquidity strain, so why is the question of a buy-side institution supplying liquidity important at all, right? Is it that overall we find, and you have a time series starting from 2002 until 2012, right? 2014. And the question is, over this time, do we find that there is a change in the liquidity profile of the dealer community, which is, as you say, there's a reduced liquidity, and then this question sort of sets itself up as a more interesting one, saying, in a market that is moving to illiquidity, are there some types of institutions that actually supply or demand liquidity? So the setup is a bit of a the second part of this question is, we seem to be saying that dealers are putting up less and less capital, and again this is anecdotally cited from a few articles, etc., saying that dealers are putting up less and less capital in the bond market, right? And again, to my mind, it raises the first question of, if that is the case, then has it impacted liquidity in the bond market? So to my mind, liquidity is just that there are a set of people who are willing to take positions, right? So there are basic measures of liquidity which are used in exchange markets, so simple traded volume, open positions kind of things. And the question to ask is, what do we observe about patterns of liquidity in the bond market itself? And unless we have some sort of a setup that enables us to view the question of mutual funds in that context, I'm not sure whether, you know, I mean, the results are interesting if there's a good context to look at it. The third is the fact of the significance of the contribution of mutual funds, right? So you show somewhere that around 18% of total bond market holdings are with, corporate bond market holdings are with mutual funds. Is that correct? 18% of the total bond market holdings are with mutual funds, right? And this has been growing over time. So it started with 7% somewhere in the early stages of your analysis period, and then it ends up at 2016. Then the question I would ask is, if bond funds are and 16% are a relatively small proportion of the overall bond market, then how do you place this study that you have done in that context? So for example, if we did find that bond funds were liquidity supplying institutions in a very significant way also, then their contribution to the overall bond market liquidity is low. And then the question is, from the perspective of the dealer who's making market in this space, then how does this whole thing play out? Which is to say, then who are the liquidity suppliers for the dealer? Because clearly, if there is a market which has a reasonable degree of liquidity, it means that there are two parties who are willing to take positions. And in that context, we find that bond mutual funds are relatively small, right? So the question is then, what is driving dealer liquidity? So what enables dealers to take positions in this market? The other are some small comments. One is, do you find changes? So, you know, if you were to do simple assessment of standard market liquidity measures in the bond market setup, would one observe different types of liquidity in the inventory load phase versus the unload phase? So for example, when dealers are buying bonds, clearly somebody is selling it to them, right? And the question is there a different liquidity that one observes here versus the other? The second is the funds themselves, and when they are either demanding or supplying liquidity. What kinds of instruments are there? So one of the problems, at least I think of in the bond market context, is just the sheer variation in the instruments, right? Which is that you may have minor variations leading to a variety of instruments, and you have, yeah, sure. You have this question of positions, the number of positions they hold, which you look at. And the question I would ask is, are there some types of instruments in which there's liquidity supplying versus, so is it that when a bond is liquid, then the behavior of liquidity supplying funds is to supply more liquidity to those bonds? So it's unclear to me whether, so if there is an economic function that some types of bond funds are performing in this market by supplying liquidity, then the interesting question is what type of instruments do they choose? If it is already liquid instruments versus illiquid instruments, then, there's a variation that's interesting to look at. Yeah. Oh, the final point, which is again a, so this the last part of your paper, which is to say that liquidity supplying as a trading strategy is persistent and it yields positive alphas, right? It seems like a bummer to me. If it's so obvious, why doesn't everybody do it, right? It's just, if there is an alpha, people, and if this alpha is as simple as liquidity, like everybody would catch it and you wouldn't have it any longer. But you're observing them, and you're observing them persistently, and there's some significance in the numbers that you observe. Why? Why do they persist? And again, it's a question worth asking on what is, so you are assigning these alphas to the liquidity supply trading strategy. And I'm not so sure whether it's just that. Right? Otherwise, if it is just that, then why wouldn't everybody just come in and remove that? So that's the set of my comments.
Thank you. Thank you.
Thank you.
Anjali.
Can I respond for just a minute?
Yeah, Kumar, would you like to respond?
Yes, thank you.
Yeah.
I think, hello. Thanks. Those are excellent comments. I think I just want to address the first few where you asked about whether there has been any change in dealers' behavior. Absolutely. So that's a paper that I published in the Journal of Finance. That's already forthcoming. So all these issues that you raised has already been addressed in that paper. So it's been shown that dealers in aggregate have reduced their capital commitment. They are moving to an agency model of intermediation, and it's resulting in certain attributes of market quality that are hurt. For example, the time to execution to complete a trade might be longer today. So even if you're paying the same bid-ask spread, if it's taking you 1 day to complete the trade rather than 2 hours, that's a reduction in market quality. So that I think addresses several of the comments that you raised. And I think we need to clarify that a little bit more in the paper. I think you raised many good questions regarding extensions, which we can take a look at, inventory load cycle versus unload cycle. So the last thing I want to address is about why doesn't everybody do that? I think that's an interesting question. I think it's because this is not a centralized limit order book market. This is a relationship-based market. So it's like saying, if my uncle is an Audi dealer, it's more likely that I'll get a good deal on my Audi when I purchase it. So in this world, if you have relationship with the dealer, if you're a large mutual fund, you have that sort of a relationship with the leader. If you're PIMCO, then you may have the connections, and that is something that we would like to.
So, I think what worries me about this argument is when you build up the profile of the liquidity supplying bond funds, you say that these are newer, smaller TNA funds, and so the question is, it does not credibly lend itself to the argument you are making. So a smaller, low total net assets fund is like the dealer's uncle, the buyer's uncle. It doesn't lend itself so well to that. So perhaps some more investigation into that maybe. So
I agree.
Okay, so can we actually take this afterwards, and we'll move to questions, and we'll do Yesha, Pradeep, and Harsh.
Great. Kumar, that was a terrific paper. One question that I had for you, and one observation that's been happening in the bond market, is actually the enormous fragmentation in the bond market structure that is actually far more than in equity market structure. I think by current figures, there's like 5 new platforms that are emerging almost on a monthly basis, and I think there are now around sort of 120 trading platforms for bond market securities. So I guess my question is twofold. Firstly, what's interesting about this fragmentation is that asset managers are some of the players that are providing these platforms. So in that context, firstly, what's the overall effect of market fragmentation on your story in terms of who's supplying the liquidity and why they're doing it? And number 2, to the extent that some of these asset managers are sponsoring these new platforms, is that sponsorship pressure one of the reasons why you see certain mutual funds take on a liquidity supplying role far more actively in the marketplace than others?
We'll just take all the questions together, and then if we have time for the answers, Pradeep.
Thanks, Kumar, for a great presentation. I find it difficult to sort of buy the story in the way you've stated it. First, the supply. When you say supply liquidity, you motivated it on the basis of the fact that now the dealers are not there to provide bidai to buy when somebody wants to sell and sell when somebody wants to buy, because of proprietary trading restrictions, and because of that, there is much more need for people like these other institutions to supply liquidity. Now, that kind of liquidity is a liquidity which is on a very short-term scale. So when I go to a car dealer to buy a car, I want the car now. I don't want the car over the course of the next 3 months. So I think there is some kind of you're conflating in some way the business of providing liquidity to trading and providing liquidity to the market as a whole in relation to flow of funds. So flow of funds type of liquidity flow is quite different from the flow of from liquidity in a trading sense. And liquidity in a trading sense is what you have motivated your arguments on the basis of. So that's point number 1. Point number 2, we all know dealer markets have existed since a very long time, and there's extensive research on dealer markets, particularly in equities. And we know that dealers have had half-lives, which are dealers in such markets have long half-lives. So it is not uncommon for dealers to take positions for extended periods of time and be long or short for extended periods of time. Now, in that, and to some extent, that makes it very difficult for example, banks who are supplying liquidity to, the proprietary trading and inventory management trading again gets conflated. So the dealers can take proprietary positions and be holding these positions for weeks and months. Now, in that context, what you are kind of observing is that, yes, dealers have bid-offer spreads, and therefore they are on average earning money from bid-offer spreads. And on average, you find that overall these mutual funds don't supply liquidity. So clearly, there is an imbalance there anyway. But in the phase in which the dealers are unwinding their liquidity on average, these buy-side institutions, they have a positive alpha because of the fact that relative to your average, they are earning more than the others at that time, since they are on the other side when the dealers are offloading their inventory. So it's not that they are supplying liquidity in the sense that they are there when Tom, Dick, and Harry want to trade. They are supplying liquidity. They are on the other side of the dealer unwinding cycle, which is not the same thing. And overall, if you add the bid-offer spreads to the whole equation, you will not find a positive alpha for all of them. So that's
yeah.
the
quick comments.
So I have a comment and a couple of questions. One is the The fact of bank-sponsored dealer reducing capital is, I think you see in India as well in the last couple of years. And the reason of that, I think, has to do with capital requirements in banks. Because all of these credit portfolio need capital is becoming more expensive, and banks are not willing to inventory bonds. I have two questions. One is I take up from where Anjali left, which is I find it hard that 18% ownership would provide liquidity. It just doesn't make sense. It's like tail wagging the dog. But the bigger issue is if the regulator is worried, won't you think simply running a repo window from the regulator would be a better solution to this? Especially if there is alpha in it, because then regulator will not even have cost of running that repo window. That's the simplest way of imparting liquidity to, if there is especially a left tail event on. And the last point is, why do we believe that when there is a redemption pressure on sales, I mean on broker dealer, there is not redemption pressure on funds? And why is it that, is there a structural reason why investors in those mutual fund would have different investment preferences than the overall market?
Thank you. I think, Kumar, you'll have to take them offline at lunch because we are out of time. Thank you very much.